Now, the end of the financial year is always a time to pause and reflect, but also a time to consider the coming 12 months. There's also the closing of the books for most public companies, which will report mostly in August. And it'll be a strange time because for all of the sharp share price falls, many of the profits are likely to be quite spectacular. But that was yesterday. The markets will always focus mostly on the outlook. To help us with that, I spoke with Stott from 1851 Capital, one of Australia's most highly credentialed investment managers.
The share market's telling us, Ross, there's a bit of pain to come. So as we've seen in more recent times, particularly in the small cap end of the market where we look, the small cap index is down 20% off its highs only 6 months ago. Share prices of retail companies in some cases have more than halved. In the last 3 to 6 months, we're seeing results come out of the US, particularly from those retail companies which are quite poor. So it feels like the next 6 months is going to be a challenging time for the Australian economy.
OK, so that being the case, though, there's companies in Australia right now that are withstanding the risks that are out there, the energy prices, the rising wages, the rising supplies. So given the fact that there are going to be those that do well, which is your job effectively to pick those out, how do you identify them right now?
Companies with pricing power are certainly well positioned in this environment. So, particularly with the high level of inflation we've got in the system.
So give me the example of companies with pricing power. I mean, are they with duopolies and monopolies and all that sort of stuff? Is that what we're really talking about here?
In addition to that, I'd say companies that have got a really strong market position and perhaps a shortage or a high demand still for their products. So there are pockets in the market where you can still find these type of companies. We've got a few in our portfolio that have even had profit upgrades more recently, which is quite unusual in this environment. There are. If you look hard, there's some out there, but certainly they would be the ones that are in the best position going forward over the next 12 months. From that perspective, strong balance sheets going forward as well. Most companies have fairly well capitalised going through the pandemic, so it's going to be an interesting time ahead.
But you talk about it year on year, the stock market's down around 8%. Then you talk about your area, small caps down around about 20%. I mean, they're big falls for shareholders to sort of, if you like, stomach, and yet there's potentially more of that ahead as people don't yet know where interest rates are going to finish, what the impact on the economy and on earnings might be.
Yeah, look, I think as we know, the market moves 6 to 9 months ahead of the economy. And so our sort of feeling at the moment is we'll see a low in the market over the next 6 months. And there's a few key signs we're looking for. Firstly is the 10-year bond. We're starting to see the yield curves flatten slightly in more recent times, so we're keeping a close eye on that. Secondly, how companies react to negative news, from a share price perspective. So the August reporting season results will look pretty stellar as a whole, but outlook statements we suggest will be quite poor with the slowing economy that we're seeing right now as we speak. So they're two of the key signs that we're looking for. But certainly negative year for the market, but coming off a really strong couple of years at the same time for the 12, 18 months before that. So some would say a fairly healthy correction going forward. But so there's some of the signs we're looking for to see the market re-rate higher over the coming couple of years.
And yet there's one aspect of this, and that is the household sector is clearly pivotal to the way in which Australia's economy performs. And when you looked at this week's retail sales, you've had 5 record months in a row. It appears as though the consumer, for now at least, is sustaining higher prices, is not so worried about job security, and they're continuing to spend on a range of things. Didn't matter whether it was department stores or dining out. They were doing the whole lot.
Particularly on the services side of the economy, Ross, as you say, so restaurants, cafes, absolutely flying at the moment. What we're seeing sort of sluggishness is in the homeware space. So companies like Adairs, in particular, we were all at home in lockdown. We spent a lot of money at home, didn't we? And that's all starting to come back now. So particularly that services side of the economy is really showing signs of strength. Travel I'd throw in there as well. We see the photos and the footage from the airports through these peak periods. So it's going to be interesting going forward in terms of how much the consumer does slow down, because we do know that interest rates are going to move dramatically higher, probably another 1.5% to 2% over the next 6 months. OK,
so there's two factors there. One is interest rates, the impact on mortgage, whether that crimps spending power. Then the second aspect is job security. Now, at the moment, unemployment with a 3 in front of it looks very good. People are confident about their prospects. But whether that changes as interest rates rise and it bites company, and that spare capacity in our economy gets taken up, plus also inbound tourism and migrants, students returning, whether that takes some of the pressure off. If unemployment starts to rise in Australia, that's really where all bets are off, in my opinion, at least anyway. Is that your own view? Because that really does start to hurt the household sector. home prices, and then even potentially banks?
Absolutely. Look, as we know, unemployment's a lag indicator, so we expect that it's probably starts to climb higher from here. But as you say, there's still buffers out there. We've got a savings rate north of 10%, highest it's been in 40 years. We've still got consumers with a mortgage that are still significantly well ahead in their mortgage repayments, given they've taken advantage of those low rates over the last couple of years in particular. So in a sense, there's still a little bit of a buffer there. But when you fast forward and you look at, there's still 40% of people that have got to roll off a fixed rate mortgage towards the end of 2023. So there's a bit of pain to come there as they move to more variable rates. So there is a buffer there that will be absorbed, we think, over the next 6 to 9 months. But it really depends on how high the RBA push rates. And we've seen, the governor out there trying to, calm people down. Because we haven't been through a tightening cycle like this for well over 15 years. So it's going to be a shock to many.
And there's also that question as to whether central banks here and around the world actually get their settings right. As we've heard from Jerome Powell this week, he actually is prepared, even if it causes pain in his economy, to crush inflation because he thinks longer term that's the greater ill. Just one thing, when you're looking out into the future over the next 12 months, what types of stocks or industries are you looking at? You talked about those that can actually sustain the price rises, but is it actually sectoral that you're looking at right now, or is it just individual companies that will do better or worse?
Probably a bit of both. So, PSC insurance brokers, insurance broking business is our biggest holding in the portfolio. We all know the price of insurance is going up dramatically at the moment, and so they're a big beneficiary of that across various lines, in particular cyber part of their business. So that's one that we feel as though can ride through a softer economy quite well. Oz Forex is another one, international currency transfer business. Again, there's always a need for that type of business through a recession. If we do go into a recession, we're not assuming we will, but economic growth will slow, no doubt.
Chris Stott, as always, great to have you on the program.
Thanks, Ross.